Good afternoon, everybody. Today, the topic is preparation of books of accounts. As regards preparation of books of accounts, we can segregate it into two sections. One is the primary section, and the second one is the secondary, or you can say the practical system. So long as the primary system is concerned, we can talk about recording of transactions through journal first, and subsequently they are posted into the ledger. As discussed yesterday, journal means it is a systematic recording of business transactions with the significance of debit and credit. When there is no significance of debit and credit, personal account for which the rule of recording is debit the receiver and credit the giver, and for real account the rule is debit what comes in and credit what goes out, and for nominal account the principle of recording is debit all losses and expenses, credit all gains and incomes. With these three basic rules, which is called the golden rule of recording of transactions, we can record holding this transaction. Transaction, as we already discussed in the last class, transaction means any business event which is measurable in terms of money. If it is not measurable in terms of money, whatever important or vital that might be, it cannot be regarded as a transaction, and hence it cannot form part of our financial accounting. So when a transaction takes place in the business, it has to be recorded in form of journal. Take the example of introduction of capital of rupees 1 lakh. If this is a transaction, first we need to identify that how many accounts are involved in this transaction. And from this transaction we can see, then we need to find out that which category of account they belong to. The capital account, whether it is a personal account or a real account or a nominal account. The other account is the cash account. We need to find out that which category of account that also. That means the cash account, whether it is a personal account or a real account or a nominal account. As we have seen that all assets are real account. Real accounts represented by assets and properties of the concern. So cash being an asset, obviously it is a real account. And capital account is a personal account. What type of personal account? It is a representative personal account, because by the person who has contributed the capital, or you can say he or she is the owner of the organization. Cash account is the personal account, and the real account is the capital account is the personal account, and cash account is the real account. Then we need to find out that what is the rule for recording of transaction for personal account, and what is the rule for recording of transaction of the real account. For personal account, the rule is debit the receiver and credit the giver. So here, who is the giver? The person who has contributed the capital. He is the giver. That means the owner is the giver. So his account has to be credited. Since he has represented through the capital account, so capital account ought to be credited. And as regards the real account is concerned, the principle of real account says debit what comes in and credit what goes out. So when capital is introduced in form of cash, obviously cash comes into the organization. So cash account has to be debited and capital account has to be credited. The amount will be 1 lakh. And each and every transaction must be supported by the narration, which will give the particulars of the transaction which is being recorded in form of journal. That is called narration. So when transaction is recorded, take the example of another transaction. Say, suppose furniture is purchased or rupees 10,000. If this is a transaction, then we need to identify that how many accounts are involved in it. When furniture is purchased on payment of cash, so obviously there is involvement of two accounts. One is the furniture account and the second one is the cash account. And fortunately, both the accounts belong to the same category, that is assets. So both are real account. And the rule of real account says debit what comes in and credit what goes out. So in case of purchase of furniture, when furniture is purchased, obviously the furniture comes into the organization. So furniture account ought to be debited. And when we are making payment for purchase of furniture, cash is going out. So what goes out that has to be credited, so cash account will be credited. So the complete entry will be furniture account debited to cash account. So in this way, all the transactions can be recorded in form of journal. After the transactions are recorded in form of journal, they are to be posted into the ledger. Ledger is meeting the second component of the definition of accounting, that is called classify. The classification is done. The classification is done in respect of nature and character of the transactions. If the transaction and if the character and nature is one, they are to be placed in one place, and different depending upon the nature and character, they are to be classified. Take the example of purchase. Purchase are of three categories. It should be listened very carefully. Suppose we are purchasing a furniture. Take the example of a grocery shop. I am giving you a particular example of a grocery shop so that it will be made clear. In case of a grocery shop, when it is established, first it will buy the racks, showcase, etc. It will buy the weighing machine for purpose of its use. So that is purchase. Purchase of fixed assets. When fixed assets are purchased, they are to be debited to the concerned assets account. That is also purchase. Then after buying of the showcase, racks, etc., then it will go for buying of the foodstuffs, etc., rice, dal, sugar, oils, pulses, etc., which have to be traded in the shop. When that is purchased, that is not purchase of fixed asset, that is purchase of current asset. When purchase of current assets are effected, which are meant for resale, this is called the purchase account or the goods account. There can be third category of purchase even. Suppose the grocery shop owner has purchased the paper-made tungas, polythene carry bags, etc. for purpose of packing. That is also purchase. The third category of purchase is also purchase, but that is neither purchase of fixed assets nor purchase of current assets. It is purchase of petty items which are meant for own consumption of the shop owner. That has to be debited to the concerned expense account, being a nominal account. So here there should not be any confusion about purchase. All the three categories are purchase. Purchase of fixed assets is purchase. Purchase of current assets is purchase. Purchase of petty items are also purchase. But purchase of fixed assets have to be debited to the concerned assets account. Purchase of current assets which are meant for resale, they are the real purchase which are to be debited to the goods account or purchase account. And the third category of purchase which is made effected by the owner for purpose of its own consumption, that is to be debited to the concerned expense account. That means either packing material or miscellaneous expenses if the paper-made tungas and polythene carry bags are being purchased for purpose of supplying of goods to the customers. Similarly, when current assets are purchased for resale, they are the real purchases and they are to be debited to the goods account. When journal is recording all the transactions one after other and they are posted subsequently into the ledger, if we go on recording each and every transaction through journal, the journal book would be so voluminous that it would be very difficult to refer. It would be very difficult to handle also. But that is the basic pattern of recording of transactions so far as the double entry system is concerned. So when this practical difficulty is being faced due to the voluminous nature of the journal book and the ledger, because each and every transactions are recorded through journal and they are subsequently posted into the ledger, a more scientific method is advanced, that is called the practical system of accounting, where the subsidiary ledger came into picture. In that case, the cash book became the book of prima entry because most of the transactions are done through cash, either through cash receipts or cash payments. That's why the cash book is being considered as the book of prima entry, where all the cash receipts are to be recorded in the debit side of the cash book and all the cash payments are to be recorded in the credit side of the cash book. The left hand side is called receipt side and the right hand side called payment side or the disbursement side, debit and credit. After recording of all the cash transactions either cash receipts or cash debits in the cash book, then certain other categories of voluminous transactions, they are recorded in form of subsidiary books, and there are 6 subsidiary books after the cash book is being considered. They are called purchase book. Purchase book records all credit purchases. Only credit purchases have to be recorded through purchase book. Now the question, there may be a question that where the cash purchases have to be recorded. Cash purchases are to be recorded through cash book only, because the cash book records all cash receipts and cash disbursement. When when cash purchase is effected, that means payment is made instantly against the purchases effected. So it has to be recorded in the cash book itself. So only the credit purchases are to be recorded in the purchase book. Similarly, there is a second subsidiary book or subledger, which is called the sales book. That sales book records all the credit transactions. Credit transactions with all the credit sales. Credit sales, the difference between cash sale and credit sale is when the payment is made instantly against the purchases effected, that is called credit purchase. Sorry, that is called cash purchase. And when the payment is deferred to a subsequent date, that is called credit purchase. Similarly, in case of cash sales and credit sales, when the payment is received in respect of sales effected instantly, that is called cash sale, that can be recorded through the cash book. But when the sales is made in form of credit, that means sale is effected today, as against which the payment will be received on a subsequent date, that is called credit sale. This gives rise to sundry debtors. Only those transactions, those sales, those credit sales are to be recorded in the sales book. That is the second subsidiary book, you can say. Then purchase return book, which is otherwise called the return outward book. When we are effecting purchases from various parties in several instances, there is every probability that there may be some purchases which are not up to our standard. There may be some purchases which are found defective. In that case, obviously, those goods are to be returned to the suppliers. When those goods are returned to the suppliers, that is called purchase return or return outward, because we are returning to the parties who are outside our organization. That is called return outward. So all such return outwards are to be recorded through purchase return book, which is otherwise called the return outward book. Similarly, there is called sales return book. The fourth category of subsidiary book is called sales return. Sales return is otherwise called the return inward. When we are effecting sales to various customers, few of the customers may not get satisfied with the quality of goods we have supplied, or for some other reason, they may return the goods to us. That is called sales return. And since the goods are returning into the organization, it is otherwise called the return inward book. All such transactions are to be recorded in the sales return book. Then the fifth one of the subledger of the subsidiary book is called the bills receivable book. Bills receivable book means when all the bill transactions took place and it is receivable in nature, then it has to be recorded in the bills receivable book. You may question that what is the bills receivable? It is as regards the bills of exchange. Bills of exchange means it is an instrument in writing containing an unconditional order signed by the maker, directing a certain person to pay a certain sum of money to certain person or to the bearer of the instrument. When such transaction takes place, that is called a bills transaction. In case of bills transaction, there are two parties. Normally, there are three parties. One is the drawer, second one is the drawee, and the last one is the payee. But in most of the cases, the drawer and the payee may be one and the same party or the same person. So there are basically two parties. One is the drawer, another is the drawee. That means when the bills are receivable, suppose a credit transaction is being effected. Both the parties, they do not know each other. So when they know each other, they can effect credit transactions because each one knows the credit worthiness of the other. So there is every certainty about receipt of the money. But when there is no such certainty, there is no such knownness about both the parties, what will happen? They will go for bills transaction. The first one will, the drawer will raise a bill on the drawee, and the drawee will accept the bill and send it back to the drawer. The periodicity must be mentioned there. The amount must be specifically mentioned there. So within that period, that means on the due date or on the maturity of the bill, it will be presented through the banker, and the bank will send it for collection, and obviously the payment will be received by the drawer. So for drawer, this is called bills receivable, and in other words, for the drawee, it is called bills payable. So all the bills receivable transactions are to be recorded in the bills receivable books, and all the bills payable transactions are to be recorded in the bills payable book. And after recording the transactions through cash book, purchase book, sales book, purchase return book, sales return book, bills receivable book, and bills payable book, there are certain transactions which cannot find place in all such books. And those transactions are to be recorded through the residual book, which is called the journal book. The entries like, or the transactions like opening entries, closing entries, and adjustment entries cannot be recorded either through cash book, purchase book, sales book, purchase return, sales return, or bills receivable and bills payable book. They are to be recorded through the residual book of subsidiaries, which is called the journal proper. Take the example of depreciation. Depreciation means, so far the meaning of the depreciation is concerned, it is gradual diminution in the value of fixed assets due to wear and tear, a flux of time, or obsolescence. So there are three clauses of depreciation. One is, it is applicable only on the fixed assets. Depreciation is applicable only on the fixed assets when the value of fixed assets gradually diminishes. That is, there are three regions of that diminution in the value of the fixed assets. First one is wear and tear, that means usability. Second one is obsolescence, means outdatedness. Third one is a flux of time or passage of time. There are certain assets which, even if it is not put to use, even if it is not subject to obsolescence, still then its value deteriorates simply due to passage of time. You can take the example of your leasehold properties or leasehold assets, leasehold land or something like that. When the periodicity is over, even if it is not used, even if it is not subject to obsolescence, still then its value will go down and down when the period passes year after year. So technically it is called amortization, but it is as similar as that of depreciation. There are three other synonyms with depreciation, that is called depletion, amortization, and dilapidation. Amortization is applicable in case of intangible assets. Depletion is applicable in case of exhaustion of natural resources, and dilapidation is applicable in case of long-term leases. When the tenancy agreement is executed on long-term tenancy basis, then on that particular case, the dilapidation clause is applicable, where the treatment has to be effected in one and the same manner, just like depreciation, amortization, and depletion. So here, depreciation, when the depreciation to a fixed asset takes place, if this is a transaction, then we need to find out that how many accounts are involved in it. If this is the transaction, then there are two accounts involved in it. One is the concerned fixed assets account, which is subject to depreciation, and the second one is the depreciation account itself. Suppose furniture and fixture is subject to depreciation. The value of the furniture and fixture is 10,000. It is subject to depreciation at the rate of 10%, say, in the first year. So 10% of 10,000 is coming to 1,000. So when that depreciation has to be accounted for, it cannot be accounted for either through cash book, purchase book, sales book, purchase return, sales return, or bills receivable or bills payable book. How it is to be recorded? It has to be recorded through a journal entry, and journal proper is the appropriate place to record all such transactions. The entry would be depreciation being an expense, it's a nominal account, and the principle of nominal account says debit all losses and expenses and credit all gains and incomes. So here depreciation being a loss to the organization, being an expense in the hands of the entrepreneurs, it has to be debited. And the value of furniture goes down by 1,000. So that's why it has to be seen that debit all assets, real account principle says debit what comes in and credit what goes out. So when the value of 1,000 is reduced from the amount of furnitures, so it has to be credited. So the entry will be depreciation account debited to furniture account. This entry cannot find its place either in the cash book, purchase book, sales book, purchase return, sales return, bills receivable or bills payable book. That's why the appropriate place of recording of such transaction is journal proper. So all such adjustment entries have to be recorded through the journal proper. So when all these books of accounts, then how the cycle will be affected by this? Suppose we are segregating, most of the transactions are recorded in the cash book, all cash receipts and cash disbursements, and credit purchases are recorded in the purchase book. In the purchase book, if you will look to the specimen of the purchase book, you will find that the name of the suppliers are mentioned there, and invoice number, etc., are also there, and the amount of purchases effected and its details are also there. When a transaction is recorded in the purchase book, each and every individual amount has to be credited to the supplier's account, and at the end of the period, the entire purchase account, the entire figure in the purchase book are to be posted into the purchase account in the ledger. So thereby, the double entry system, each debit has got equal and corresponding credit and vice versa, that is being properly effected. When the accounts of individual suppliers are being credited, that has to be recorded in the ledger, and the sundry creditors account will be exhibiting the balance which is to be payable to each and every suppliers who has supplied the goods to the organization. And when the term of credit is over, on the due date, the amount can be paid to the creditors so that they will not hesitate to make the supply to the organization in the next phase. The same thing also happens in case of a sales book. When the credit sale is effected, to whom the goods are effected, to whom the credit sale is effected is known as a debtor. Combination of all the debtors is called sundry debtor. When they are recorded in the sales book, the customers, the individual customers account has to be debited, and the summation of the periodic summation of the sales book has to be shown in the credit side of the sales book. When the credit sales is credited with the sum total figure, and the individual customers account are being debited with individual figures, the summation of all the individual debtors must tally with the amount of figures shown in the credit side of the sales book. Thereby, the double entry system of bookkeeping is being parallelly effected. One account is debited and the other account is credited with a similar figure. The same thing also happens in case of the journal proper, when each and every account is debited with a corresponding credit to the other account. So after recording of transactions through cash book, and which is called the book of prior entry, and the other subsidiary books like purchase book, sales book, purchase return, sales return, etc., etc., when they are posted into the ledger, then from the ledger we can go to the next step of the definition of accounting, that is called summarizing by preparation of a trial balance. Trial balance means it is a statement which is prepared on periodic basis containing the closing balances of all the ledger accounts in order to be sanguine about the arithmetical accuracy of the books of accounts maintained. When each debit has got an equal and corresponding credit and vice versa, then summation of all the debits must tally with the summation of all the credits, being a mathematical truism. So in the trial balance, when we prepare the trial balance, the accounts showing debit balances are shown in one column, and the accounts showing credit balances are shown in another column. And the summation of all the debit amounts must tally with the summation of all the credit amounts. When the accounts, when both the sides are not tallying, that means it gives rise to some flaw in maintenance of accounts. That's fine. That's why the arithmetical accuracy is not maintained. As a result of which we can ensure that there is certain flaw in maintaining or recording of transactions or posting them into the ledger or balancing in the cash book or whatever it may be. After that, after the trial balance is being prepared, trial balance is meeting the summarizing part. Whatever accounts are recorded through purchase book, through sales book, through purchase return, through sales return, when they are posted into the ledger, and from the ledger we are preparing the trial balance, that trial balance would be meeting the summarizing part of the definition of accounting. That means from that we can know what are the assets, what are the liabilities, what are the expenses, and what are the incomes incurred by the organization during that particular period. It may be, the period may be a year, the period may be a half year, the period may be a quarter, the period may be a month, or the period may be a week even. So periodically, the statement which is prepared to know the arithmetical accuracy of the books of accounts, that is called the trial balance. The trial balance is based on a principle. The principle is debit all assets and expenses and credit all gains and liabilities. That means whatever items appearing in the debit side, in the debit side of the trial balance, it must be either an asset, and if it is not an asset, then it must be an expense. Similarly, when we refer to the credit column of the trial balance, then all the items entered in the credit column of the trial balance, it is either a liability, and if it is not a liability, it must be an income. So accordingly, after preparation of the trial balance, the effects have to be given in the financial statements. When you talk about the financial statements, it will come, we will know about the profit and loss account and the balance sheet, etc. But here, when we are maintaining the cash book, being the book of prima entry, we should know that what is the procedure of maintaining the cash book. The cash book may be maintained in single column. The cash book may be maintained in double column. The cash book may also be maintained in the triple column basis. When the cash book, when the cash book is there only, when the cash book contains only the cash column, it is called the single column cash book. When the cash book contains this cash column along with the bank column, it is called the double column cash book. At times what happens, the cash book contains cash column, bank column, as well as a discount column. In that case, it is called the triple column cash book. At times, the cash book gives rise to contra entries. Contra entry means when both the aspects of a transaction are placed in one book, that is called contra entry. Suppose the cash book is maintained in double column. That means the cash column as well as a bank column both are there in the cash book. In that case, when any deposit is made, any cash deposited in the bank account, the entry will be what? Bank account debited to cash account. Here, no journal entry will be done. It will be recorded through the cash book. So what will happen? It will be reflected in the debit side. That means in the receipt side of the cash book, in the bank column, it will be recorded. And in the payment side of the cash book, it will be shown in the cash column. That means both the aspects of that particular transaction is being recorded in the cash book itself. That's why it is called contra entry. Contra entry means when both the aspects of the transactions are written or are completed in one book, that is called contra entry. Similarly, when cash withdrawn from bank, when the cash is withdrawn from bank, then the cash balance will go up So that will be recorded in the receipt side of the cash book. That means in the debit side of the cash book. And since the amount is withdrawn from the bank, it will be recorded in the credit side of the bank column of the cash book, so that the bank balance will go down and here the cash balance will be increased to that extent. That is also called contra entry. When contra entry is there, then no ledger folio will be assigned to them, because both the aspect, it will not be posted to any ledger account. So in the ledger folio column, it is being marked as a capital C in both the sides, both in the receipt side as well as in the payment side. Thereby, we can ascertain that it is a contra entry. That means both the aspects are recorded in the cash book itself. Secondly, when discount is received or discount is paid, no separate account is being maintained in the ledger for that, because it will be entered in the cash book itself. Discount received is an income for the organization, so it will be recorded in the discount column in the receipt side of the cash book. So no need of separately maintaining a discount account in the ledger. That is also that also gives example of the triple column cash book. Triple column cash book means one cash, one bank, and one discount. Again, after preparation of the trial balance, when the trial balance is agreeing, that means the debit side is showing about the assets, expenses, and the credit side is showing about the liabilities and incomes. Thereafter, we can go for preparation of the financial statements, final account. When the final account has to be prepared, we need to find out what are the statements are included there. The first one is the income statement, and the second one is the balance sheet or the position statement. When we talk about the income statement, there are two components involved in it. One is the trading account, another is the profit and loss account. Trading account exhibits the gross profit or gross loss of the organization. Gross profit means it is represented through an equation. The equation of gross profit is sales minus cost of goods sold. Cost of goods sold is it can be replaced through another equation, which is called the opening stock plus purchase plus direct expenses minus closing stock. When from the equation of gross profit, the cost of goods sold is being exchanged by this equation, then the final equation for gross profit would be the sales plus closing stock minus opening stock minus purchases minus direct expenses minus closing stock is minus direct expenses is the equation of gross profit. That means here two items are with positive symbol. That means sales and closing stock are with positive symbol, and opening stock, purchase, and direct expenses are with negative symbol. The negative symbols are kept in the left hand side of the trading account, that means in the debit side of the trading account, and the items with a positive symbol, that means sales and closing stocks, are kept in the right hand side of the trading account. And that's why it is called, the trading account is the tabular presentation of the equation of the gross profit. When we are putting in the credit side the closing stock and the sales, and in the debit side the opening stocks plus purchase plus direct expenses, the balancing figure may appear in the debit side or may appear in the credit side of the trading account. If the balancing figure is appearing in the debit side of the trading account, then that would be gross profit, because the incomes are more than the expenses, the revenue. That means the sales plus closing stock is more than the opening stock, purchase, and direct expenses. Here in this connection, there may be a question: what is the meaning of the term direct expense? Direct expense means the expenses incurred for bringing the goods from the place of purchase to the place of effecting sales. That means indirect expenses like salesman's salary, electricity, rent of office, all these things are called indirect expenses. But direct expenses means the wages, the carriage in ward, etc., which are incurred for purpose of bringing the goods from the place of purchase to the place of effecting sales. They are to be recorded as direct expenses, and all direct expenses are to be incorporated in the trading account so that the gross profit or the gross loss will be arrived at. When the when the balancing figure is appearing in the debit side of the trading account, this gives rise to gross profit. When the balancing figure appears in the credit side of the trading account, this gives rise to gross loss. The trading account will either show a gross profit or a gross loss at a particular point of time. This gross profit or gross loss has to be transferred to the profit and loss account. The profit and loss account is the subsequent stage after preparation of the trading account. Profit and loss account itself is a nominal account, and it is said to be the graveyard of all the nominal accounts. Graveyard means end of one's life. That means when the profit and loss account is prepared, it brings an end to all the nominal accounts that are available in the ledger. When we are preparing the ledger account, after posting of items from the journal to the ledger, either it will be posted in the debit column of the ledger or in the credit column of the ledger. Before preparation of the trial balance, we need to make the balancing of the ledger account. Balancing of the ledger account means each and every ledger account has to be balanced to find out which type of closing balance it is showing. Either it is showing a debit balance or it is showing a credit balance. Accordingly, they are to be taken into the trial balance either in the debit column or in the credit column. While preparing the trial balance, the same principle has also to be taken into consideration. The principle is debit all assets and expenses, credit all gains and liabilities. So when we are preparing, take the example of cash book. Cash book will never show a credit balance. Cash is an asset. Asset debit all asset means all assets must be showing the debit balance everywhere. Take the example of capital account. Capital account will never show a debit balance because it's a liability, and liabilities ought to show credit balance always. Exceptionally, in case of drawing, if there is any drawing from capital account and the drawing is more than the capitals introduced, in that case the capital will show a debit balance, and in that case capital will not be regarded as a liability, rather it would be an asset to the concern. Here there may be a question that why capital is liability. In that connection, we can refer to the concepts of accounting and conventions of accounting. Concept means the assumptions and ideas which are fundamental to accounting study and practices. When we are making recording of transactions or we are preparing the maintenance of books of accounts which are called the business books, we must keep in mind the concepts and conventions of accounting. Concept of accounting means the assumptions and ideas which are fundamental to accounting study and practices. Assumptions and ideas which are fundamental to accounting study and practices is called concept. There are about 10 concepts in total. The first one is separate entity concept. This separate entity concept says that the business and the owners of the business are completely separate and distinct from each other, irrespective of the status of the organization. The status of the organization may be a proprietorship concern. The status of the organization may be a partnership firm. The status of the organization may be a joint stock company. The status of the organization may be a cooperative society or trust or association of person or whatever it may be. But always when there is a business, there must be owners of the business. The separate entity or the business entity concept says that the owners are completely separate and distinct from each other. When capital is introduced, capital is obviously the asset of the owner. It's the asset of the owner. But when it gets invested in the business, suppose the owner is investing 1 lakh rupees as capital in the business. So that 1 lakh rupees what he is having, it is obviously its asset. It's assets of the owner concerned. But when it gets invested in the business, then since the business is different from the owner, it became the obligation of the owner to pay it back to the businessman, to the owner. That's why it is called liability. Anything payable is liability, anything receivable is asset. Similarly, when a net profit is earned. Suppose at the end of the year, there is earning of profit to the extent of 30,000. What is that? That 30,000, whether it is an asset or a liability to the concern. When there is a profit earned in the organization at the end of the period, obviously it is a liability. Why it is liability? Because it is a liability so on account of the separate entity concept. The profit earned in the business is exclusively due to the owner because it is the effect of the profit is the effect of or the resultant of the investment made by the owner and the efforts given by the owner for the business. So he is entitled to enjoy the profit. Who? The owner is entitled to enjoy the profit. That means the amount of profit earned in the business is receivable by the owner from the business. In other words, you can say that it is payable by the business to the owner. Anything payable is liability. That's why the amount of profit earned in the organization is added to the capital and it is shown under the liability side of the balance sheet. Similarly, when there is a loss, the loss is due to the ineffective management made by the owner for its business. In that case, it is the obligation of the owner to reimburse the amount of loss sustained by the business to the business itself. That's why anything receivable by the business is asset. Net loss is shown as an asset. In other words, it is shown by way of deduction from the capital in the balance sheet. This is the first concept, separate entity or business entity concept. The second concept is the dual aspect. Dual aspect means every debit has got an equal and corresponding credit and vice versa. This is another core concept of accounting. And this dual aspect concept also gives rise to an important equation, accounting equation, that is called capital is equal to assets minus outsiders liability. And this equation holds good at every point of time. This is called dual aspect concept. The second concept is dual aspect concept gives rise to the equation that is called accounting equation. What we have already said, that capital is equal to assets minus capital is equal to total assets minus outsiders liability. The third concept is going concern. Going concern means the account it is if the periodicity of the business or the entity or the organization is not indefinite, but still then it should be a long period of time and the period should be long enough to complete all its existing plans and commitments. That is the result of the going concern concept. The fourth concept is accounting year concept. If we will strictly go by the accounting going concern concept, then what will happen? The true profit or true loss can be ascertained only after all the assets are disposed of and all the liabilities are cleared up. But that is not possible. No one can afford to wait for that period of time which will lead to the closure of the organization. No one can afford, no users of accounting information can wait till the closure of the business for ascertaining the profitability of the concern. In order to meet the difficulties involved in that, the accounting year concept has been designed where the entire period is segregated into a period of 12 months, preferably the financial year, for which the profitability statement is to be prepared, and at the end of the period, the balance sheet has to be prepared, which will speak about the position of assets and liabilities of the organization. So after that, the fifth concept came into picture, which is called the money measurement. It is one of the important concepts of accounting, and at the same time, it is a serious drawback of financial accounting also. Money measurement concept says that the transactions which are not measurable in terms of money, it cannot form part of financial accounting. Anything which is not measurable in terms of money, that cannot form part of financial accounting, whatever important and vital that might be. If you take the example of the sickness of the owner for a long period of time and finally he's passing away, it is, so to say, the most important event of the organization because he is the founder, and his disappearance from this world may lead to closure of the organization. So his death or expiry is such an important event which is much more important in comparison to that of other events. But even if it is the most important event in the entire history of the organization, still then it will not form part of financial accounting because it is the reason is it is not measurable in terms of money. So money measurement concept, one of the important concept, as well as at the same time it is a drawback of financial accounting even. The next concept is historical cost. Historical cost concept says that the assets are to be recorded at the price which is actually paid at the time of its original acquisition, and it has nothing to do with its market value. The market value may be much more than the assets at which it is being acquired originally, but it has to be recorded at the price on which it is acquired. However, it is also subject to depreciation if such asset is a depreciable asset, but it has nothing to do with the market value even if the market value is much more than the book value of the concern. It has to be recorded only on the book value which is being reflected in the books of accounts. That is called historical cost concept. The next one is revenue recognition. Revenue recognition means at what point of time we can say the revenue is recognized. Necessarily doesn't mean the receipt of money. When the sales are effected, there are different stages of effecting sales. But when we can say that the revenue is recognized or the earning takes place, when the goods are delivered along with the invoice and the opposite party accepts the invoice along with the goods in goods condition, even if the payment is not received, the payment is deferred to a subsequent date, we can say that the revenue is recognized. That's why it may give rise to the credit sales. The money is not received, the money may be received in a subsequent date, but we can say that the revenue is recognized. That is called revenue recognition concept. The next one is matching. Matching means all the connected expenses should perfectly be matched with the revenue in order to find out the true profit or true loss of the organization over a particular period. That is called matching concept. All the connected expenses means the entire income cannot be the profit of the organization. The connected expenses should preferably be deducted. Whatever connected expenses are incurred for generation of that particular income during that particular period need to be deducted from the concerned revenue or from the total revenue in order to find out the profit for that particular period. That is called matching concept. The next one is the accrual. It is an important concept so far as the final account is concerned. This accrual concept says that the incomes are to be recorded on the basis of earning and expenses are to be recorded on the basis of incurring. And it doesn't matter whether the incomes are received or not and expenses are paid or not. And this accrual concept gives rise to the items like prepaid expenses, outstanding expenses, accrued income, and income received in advance. Accrued income earned but not received. Outstanding expenses due but not paid. Prepaid expenses paid in advance. Income received in advance, it is not due to be earned, but it is received. That means income received but not earned. So all these things are to be given properly effect in the financial statement when we are preparing the balance sheet. Some will be shown as the current assets and some will be shown as the current liabilities, depending upon its nature and character. Then after accrual, the last concept is objectivity. The objectivity concept says that all the transactions must be supported by proper documentary evidences in order to substantiate the genuineness of such transactions. Let it be a receipt, let it be a payment, but each and every transaction must be supported by documentary evidences in order to substantiate the genuineness of such transaction. Otherwise, the very objectivity or very object of account will be vitiated. This is about the concepts of accounting. There are 10 concepts in total. There are 4 conventions of accounting. Convention means customs and traditions acting as guide for preparation of the financial statements. The first convention is disclosure. Disclosure, second one is materiality, third one is consistency, fourth one is conservatism. Although they are 4 in number, the first 2 are to be read together, disclosure and materiality, because the disclosure convention says that all the material information should properly be disclosed in the annual accounts of the organization. So all the material information should properly be disclosed. So what is a material information? The material information has been defined by AAA, American Association of Accountants. They have said the information is said to be material, the knowledge of which will bias and prejudice the judgment of the users of accounting information. When such information are present, that is called a material information. If that information is not affecting the judgment of the users of accounting information, then it cannot be said to be a material information and it can be ignored without being disclosed in the annual accounts. That's why the disclosure as well as the materiality both have to be read together. The next concept is consistency. The consistency convention says that there are different methods to be followed for different items while preparing the financial statements of the organization. Take the example of methods of depreciation. There are different methods of depreciation which can be adopted by the organization for any particular organization. One can choose any method of depreciation. There is no such restriction as regards choosing of any particular method, but this consistency convention says once a particular method is being chosen means the same particular method should be consistently followed from year to year without any change thereof. That is the requirement of the consistency convention. The same thing is also applicable in case of adoption of any method of inventory valuation like FIFO, LIFO, HIFO, etc. As regards methods of depreciation, also there are straight line method, there are WDV method, sinking fund method, depletion method, machine hour rate method. There are so many methods of depreciations are there. There is no restrictions as regards adoption of any particular method, either for purpose of charging depreciation or for purpose of evaluation of inventory or closing stock. But the essence of this consistency convention says that once a particular method is chosen means the same particular method should be consistently followed from year to year without any change thereof. That is the requirement of the consistency convention. The last convention is the conservatism. Conservatism means there are 2 limbs of this conservatism convention. The first limb says that all the anticipated losses should be taken into consideration, whereas the anticipated gains should be avoided. That is the first limb. All the anticipated losses should always be taken into consideration, whereas the anticipated gains should be avoided. And the second limb of conservatism convention is more and more care should be given to the liabilities always, whereas the assets can be ignored. That is the essence of conservatism convention. So far as the conservatism in convention is considered, we are making the valuation of our inventory at cost or market price, whichever is lower. The golden principle of inventory valuation is what? Cost or market price, whichever is lower. It is not we cannot evaluate our closing stocks at the cost or market price, whichever is higher. We need to, so far as the conservatism convention is concerned, it strictly emphasizes that the adoption of inventory valuation principles should be made on the basis of cost or market price, whichever is lower. So on that basis, we need to make the evaluation of our closing stock at cost or market price, whichever is lower, so that we can comply with the requirements of the conservatism convention. And this conservatism convention is another reason why the left hand side of the balance sheet is liability and the right hand side of the balance sheet is asset. So this is about the conventions of accounting. There are four, although there are four in numbers, they are to be read, the first two are to be read together. That's why the disclosure and materiality are to be read together. So fundamentally they are three, and consistency and conservatism are the third and fourth conventions of accounting. So when we talk about the maintenance of books of accounts, we need to keep all the concepts and conventions which are called the principles of accounting, on which the entire study of accounting is based, and taking that into consideration, we need to maintain our books of accounts either in form of journal or ledger, or in the form of your subsidiary books like cash book and other subsidiary books like purchase book, sales book, purchase return, sales return, bills receivable, bills payable, and the last one is the journal proper. Journal proper takes care of all the transactions that can neither be recorded in any of the subsidiary books mentioned above, including the book of primary entry that is called the cash book. So this is all about the recording of, or the maintenance of, or the preparation of the books of accounts. And the books of accounts means the books which are the business books statutorily prescribed for the organizations to be maintained. Thanks to all.